After having learned about the essentials of green bonds in the first module, we now focus on how to set a green bond framework. You will learn from Ben Powell, Senior Banker at Climate and Sustainable Finance at SEB, a green bond pioneer and leading green structural advisor, how to apply the green bond principles to set up a robust green bond framework based on the 5 core pillars. After looking into the steps of the green structuring process, questions around key market aspects and transaction considerations, including market access, liquidity, pricing, allocation, and marketing will be covered. So let's get started.
Before we dive into green bond frameworks, let's recap quickly. So what precisely is a green bond? Well, green bonds are any type of bond instrument where the proceeds will be exclusively applied to finance or refinance in part or in full new and or existing eligible green projects, and which are aligned with the 4 core components of the green bond principles. This definition was agreed upon by a consortium of major banks organized by the International Capital Market Association, ICMA, and set the foundation for creating a set of voluntary guidelines named the Green Bond Principles, or GBP, in January 2014. These have been updated annually and continue to evolve. This is one of the most widely accepted definitions of a green bond in the market. Let's unpack this definition though. Green bonds share the same underlying mechanisms as regular bonds in terms of process between issuers and investors, pricing, tenor, and secondary trading. The main difference is that only predefined projects leading to an environmental benefit can be financed. For example, a property development company can raise a regular bond to finance all types of properties and day-to-day operations. However, a green bond can only be used for predefined projects with an environmental benefit, such as for properties with 30% less energy use than the national average, or that meet certain green building certifications. The first of the green bond principles is use of proceeds and the definition of eligible projects. In other words, what type of projects the money from the bond can be used for. The issuer decides what their definition of green is so that investors can decide whether they also agree with this definition. The second principle is the process for a project evaluation and selection. This concerns the development of a process for project selection. In other words, how do you make sure that the project you select are indeed in line with your definition of green? The third principle is management of proceeds. This concerns traceability and monitoring of funds raised for sustainable finance. In other words, the procedure the issuer sets up to make sure the money raised in the bond is not mixed up with money from other sources, and that there's an easy way to track the money from sourcing to investment. The fourth principle is about reporting. It's essential to be transparent towards investors and the market by letting them know what type of projects did indeed receive funding through the green bond and what type of environmental benefit this contributed to. In addition to these 4 principles, external reviews through an independent external assessment is as of now considered a recommendation. It's not presented as one of the principles, but many investors appreciate an assessment made by an independent party with environmental competence. The 4 green bond principles are used as a guideline when creating an issuer's green bond framework. And we'll now see an example from Volvo Finance Bank. In the Volvo Finance green bond framework, the eligible projects are defined as a selected pool of loans and leases to vehicles that are funded in whole or in part by Volvo Finance Bank and that promote the transition to low carbon and climate resilient growth as determined by Volvo Finance Bank. Here you can see a list of cars that are eligible for these loans and leases. As per the green bond principles, the Volvo Finance green bond framework also outlines their selection process whereby the head of Treasury and the head of sustainability must reach a consensus, a process for earmarked accounts, and a plan for impact reporting. So, when creating a green bond framework or any other type of framework related to sustainable financial products, the first step will be to define what types of projects to include in the framework. This is covered by the first pillar, definition. It's important to identify and define investment areas and assets that are eligible to be financed by the proceeds from a sustainable finance product. This can be done with the help of product guidelines and advisory support. To illustrate this, we present two different approaches to the definition of eligible projects. The first approach is driven by a methodology with self-defined investment criteria. This provides good flexibility and can be adapted to specific circumstances of the defining party. In the green bond case, the issuer's circumstances. It also incentivizes both issuers and investors to open up a dialogue between financial and environmental experts, which facilitates mutual competence enhancements both before and after issuance. One of the disadvantages often could be that it results in a large range of individual definitions, and it therefore requires investors and other relevant stakeholders to initially spend time and resources on developing an in-depth knowledge of these definitions. This is the most commonly used approach so far in the green bond market. Second approach is choosing eligible projects from a predefined set of options. An example of this is the comprehensive green bond endorsed project catalogue developed by the People's Bank of China that lists eligible projects and provides a set of definitions. This is a method that works well when you have strong ownership, for example, as in China, as they can be flexible and adapt to technological developments. However, it could be challenging to form multinational guidelines where there might be disagreements over the exact definitions. In general, the advantages for the involved parties is that it is universal for the region covered, more efficient, and will ease the process of selecting comparables. However, it may not encourage communication and dialogue around the definitions to the same extent as self-defined definitions, which may be important for the process of mobilizing human capital for sustainable finance. In addition, if the process of updating definitions is slow, there's a risk that it cements old technologies rather than embracing new technologies, as it's difficult to predefine future developments. But, as we've seen, a predefined project list developed by a central authority may mitigate this risk. There is, of course, nothing that prevents combining these two approaches. In fact, it is indeed quite common that green bond issuers integrate existing industry standards such as certificates into their eligible project definitions. Certificates are used to ensure that a project or asset follows a verifiable standard. Many of these industry standards are an integral part of the business of an issuer and therefore natural to use as a definition. For example, PEFC and FSC are the global leading sustainability certificates for the forestry industry. For buildings, the most widely used environmental certificates are developed by BREEAM and LEED. These and similar environmental certificates can, for example, enable issuers to define certain green criteria in a clear and transparent way, and as such provide access to green financing. Although it should be emphasized that it is recommended that it is complemented by other definition tools and the remaining 4 pillars of sustainable finance. We'll now have a look at how use of proceeds is defined in the green bond framework of Kommuninvest. Kommuninvest is the local government debt office owned by a vast majority of the municipalities and county councils in Sweden. Kommuninvest, as a large entity, borrows efficiently on international capital markets and provides loans to its members. Municipalities and county councils have broad responsibilities, and in a reflection of that, the definition of use of proceeds in Kommuninvest Green Bond Framework covers 8 eligible project categories. 1. Production and distribution of renewable energy. 2. Energy efficiency in energy systems. 3. Green buildings and energy efficiency. 4. Clean transportation. 5. Waste management. 6. Water and wastewater management. 7. Climate change adaptation. And 8. Environmental management. The definition of the first one is 1. Production and distribution of renewable energy, such as wind, wave, solar, hydro, geothermal, bioenergy, biogas, and excess heat, or conversion from fossil to renewable energy. Now, selection. This is the second pillar. After a list of eligible projects or project categories has been defined, a process for project evaluation should be implemented to make sure the projects are indeed evaluated and selected in accordance with the project definitions. It is recommended to include climate or social competence in the selection process, depending on focus. There are various ways to structure the selection process. A key factor when creating a green or sustainable framework is to ensure the sustainable integrity when defining and selecting assets. One way of doing this is to have the selection process of projects done by, for example, a committee where a sustainability expert has a veto right. This is as now the most common process, particularly for green bonds, but it can be time consuming if a high number of projects need to be evaluated. Another approach could, for example, be to give professionals a limited mandate as long as a project falls within certain agreed requirements, such as, for example, a certificate. This can, for instance, relate to a green building, transportation, or forestry certificates, provided that these are already stated as eligible projects under the green bond framework, of course. This can be complemented by the use of training modules to provide professionals with the required competence level. An accompanying test could then be used to verify that the professional in question is fit to select a sustainable project as eligible without going through a committee. In Communinvest's case, the selection and approval process is described in the framework in 4 steps. As a starting point, potential eligible projects are identified within the borrowing member municipalities and county councils. The Treasury Department in respective municipalities or county councils will then select potential eligible projects and submit an application for a green loan from Communinvest, together with appropriate documentation. Within Communinvest, the lending department will evaluate and give a pre-approval. Applications that have received a pre-approval will then be reviewed and finally approved in consensus by Communinvest's Green Bond Environmental Committee. The Green Bond Environmental Committee consists of representatives from the environmental function of 2 or more member municipalities, county councils, environmental experts from other relevant public sector organizations or academia, from NGOs, as well as Communinvest management. Given that Communinvest, before entering the green bond market, didn't have in-house environmental competence, the establishment of the environmental committee was an adequate and efficient way of insourcing such competence in a way that safeguards that high environmental standards are met throughout the green bond and green loan process. The third pillar is monitoring and management of proceeds. Funding raised via sustainable finance channel should be earmarked or otherwise traceable in some way, such that the money raised for green purposes is not mixed with other sources of financing. Proceeds can, for example, be monitored through a balanced earmark account or through a virtual sustainable balance sheet. Similarly, investments, projects, or assets funded by these proceeds should be tagged to enable traceability. Here is Communinvest's description of how management of proceeds will be taken care of. The salient points are that 1, the green bond use of proceeds will be specifically tracked. 2, it is described how unallocated proceeds, if any, will be managed until allocated to eligible projects. In Communinvest's case, this includes cash, green bonds, municipal or government risk with a specified minimum credit rating. 3, Communinvest also informs investors and other stakeholders that any eligible project that, for whatever reason, ceases to meet the eligibility criteria upon which it was approved, will be removed from the pool of eligible loans. 4, they also inform that allocations will be verified by an external audit firm. The 4th pillar is reporting. It is essential to be transparent towards investors and the market. For investors, this means that they, in addition to a financial return, will be able to get a sustainability return on their investment. Reports published at least annually or more frequently should include a list of areas financed, allocated amounts, a brief description of the projects and their expected impact. This is an area which has received much attention in the market. Many investors ask for a more comprehensive description of the environmental consequences of the project they have financed, quantitatively and/or qualitatively. This is often referred to as impact reporting and goes beyond the minimum reporting requirements of the green bond principles. Each issuer must decide on how to balance the cost of preparing a comprehensive impact report against the value it may bring for investors and other stakeholders, and in the extension, the value that stronger relations to your investors may bring. Communinvest is an example of a green bond issuer that's raised their ambition level when it comes to green bond reporting. As seen on the contents page here of their green bond impact report for 2017, they provide investors with a comprehensive report of close to 50 pages. In order to develop the skills for preparing such impact reporting, Communinvest and a group of other Nordic green bond issuers from the public sector jointly developed a practical guide called the Position Paper on Green Bond Impact Report. The position paper serves the purpose of harmonizing methodologies and assumptions used by all issuers in this group. Harmonization of reporting principles can be valuable for investors when evaluating the impact of their investments, in particular for investors who have many green bonds in their portfolio. The position paper and other guides and guidelines on impact reporting are available on the Green Bond Principles webpage. The final pillar is verification. This provides evaluation through an external review by independent environmental experts. We will now look at some of the examples of verification in the sustainable finance field. External review is set out as a recommendation rather than a mandatory cornerstone in the green bond principles, but is widely used and argued for in the sustainable finance market and is particularly relevant for quality control. The main objectives of an external review is to verify the sustainability of the issuer's projects, to verify that the selection process is in line with a sustainable finance framework, and the governance procedures of the organizations which is being assessed are of a sufficiently good standard to safeguard sustainability. The content of reviews can span from an assessment of sustainability aspects, including a view on green or social definition, to verification of procedures or governance structures. Assessments can be done in the form of a specific certification or a scoring of the sustainability aspects. In addition, there are assessments that aim to verify the procedures or governance infrastructure of an issuer. Assessment categories can also be combined in what is referred to as an external review. In the green bond space, it is common practice to engage in an independent external reviewer to produce a second opinion on the green bond framework, which may include an assessment of the green categories or, in essence, the environmental content. It may also include an assessment of the alignment with the green bond principles and the environmental governance procedures of the issuers. Examples of second opinion providers are Cicero, DNV, ERCOM, and Sustainalytics. While a second opinion is typically presented prior to issuance, assurance type of reviews may also be used post-issuance depending on the assessment. For example, an assessment of an issuer's reporting may also be made by way of verification against a preset certification. Lastly, various scoring systems are available in the market where credit rating agencies and other reviewers provide specific green or green bond evaluations. Sustainability assessments are also made in more indirect ways, not directly linked to specific sustainability finance products, such as, for example, as part of the regular credit assessment or credit rating. Certain exchanges can also be communicated through selection criteria of indices or stock exchanges. Returning to our case study of Communinvest, they've engaged Cicero as their independent external reviewer and have a second opinion which is publicly available on Communinvest's webpage. Now let's go to part 2, the steps of a green structuring process. Here you can see a table showing the steps needed when going through the green structuring process and the responsibilities of each of the various parties in the process. You have the issuer, a structural advisor, which normally means that it's a bank or financial institution taking that role. And then also you have the external opinion provider. You can usually expect a kickoff meeting with relevant representatives from the finance, environmental, sustainability, legal, communication departments to first establish the contents of the green bond framework of the issuer. That then is taken to the external reviewer, the independent external reviewer, and a draft external review and a set of questions is delivered to the issuer by the external reviewer. Once that external review is complete, a call is arranged with the independent external reviewer and the issuer to finalize the document. And then the external review is delivered. Following that, a communication strategy, an investor presentation, a transaction strategy are all put in place with respect to preparation for the inaugural issuance. Part 3 covers market aspects and transaction considerations. We'll now go through a number of market aspects and transaction considerations that may differ when issuing a green bond compared to a regular bond. In particular, we'll look at some differences concerning market access, liquidity, pricing, allocation, and marketing. One of the main financial benefits from issuing bonds in green format is that issuers highlight is the improved market access. And this primarily comes in two ways. One, investor diversification. Two, issuance flexibility. Green bond issuers often achieve investor diversification on the back of a well-prepared green structuring process, including one, a solid green bond framework, two, a credible independent external review, and three, a well-executed communication strategy, including investor meetings with a solid investor presentation. Investor diversification often entails having a large number of investors in the order book and can include attracting interest from new investors. It's also not uncommon that orders are larger than usual and investor interest from geographies show up. One attempt to study the difference in market access for green and regular bonds, respectively, is found in the reports Green Bond Pricing in the Primary Market, prepared jointly by the Climate Bonds Initiative and International Finance Corporation, the private sector arm of the World Bank Group. The most recent such report covers the period October to September 2017. In that sample, the report finds that 7 out of the 15 euro-denominated green bonds issued during that period achieved the same or larger oversubscription than regular comparable bonds. The comparable numbers for green bonds issued was in US dollars was 4 out of 7. Many green bond issuers also experience that they not only reach out to new investors, but that as the dialogue with investors goes beyond the traditional financial risk-reward discussions to now also encapsulate a discussion about how the issuer addresses climate and environmental challenges in their strategy and investment decisions. And therefore, a deeper relationship is achieved with investors. More investors and deeper relationships may be beneficial for the issuer, not least when global financial market conditions deteriorate and issuers find it more difficult to roll over debt that comes to maturity. The second aspect of market access concerns issuance flexibility. To the extent that issuers may meet a larger and more diverse demand when issuing in green format, that can also foster improved issuance flexibility. This can, for instance, facilitate issuance in maturities where demand typically is insufficient for a successful transaction to take place. If the issuer base that considers buying regular bonds from a certain issuer is complemented by investors who show an interest in the issue because it is green, demand may be sufficient to successfully execute the transaction. Similarly, the potentially larger demand may make it possible for issuers to enter new markets and diversify into new currencies where the investor base previously hasn't familiarized itself with the issuer credit. With a green investment opportunity on the table a sufficient amount of investors may decide to do the homework to be able to place an order. Volume and format of the transaction are other areas where increased issuance flexibility can be achieved. Let's talk about liquidity of green bonds. How are they compared to regular bonds? In general, liquidity in green bonds in the secondary market has been poorer than that of regular bonds from the same issuer. This can be explained by the mismatch in supply and demand, where investor appetite in general has grown to exceed issuance by borrowers. Hence, there is a tendency among investors to keep their holding in green bonds for longer than usual. If they need to reduce holding of bonds in a certain sector or certain currency, maturity or rating segment, and if they can choose to sell either a green or regular bond, all else equal, it may be that they decide to put the regular bond for sale in the secondary market rather than the green. There is a higher prevalence of buy to hold among investors in green bond compared to regular bonds. With lower supply of green bonds on the secondary market, liquidity goes down. Importantly, however, the poorer liquidity is asymmetric, where the offer side is lower, but not necessarily the bid side. Quite the contrary, it can be argued that the demand for a bond from a certain issuer is likely to be stronger, with all the investors interested by a regular bond on the secondary market from the issuer are likely to be interested if a green bond from the same issuer is on sale in the secondary market. And in addition, there may be investors who wouldn't be interested in a regular bond, but who are if it's green. From the investor's point of view, the difficulty to rebalance a portfolio of green bonds due to the poorer liquidity, i.e. the supply, may be frustrating. Of greater importance may, however, be that there is demand in the case that you, for whatever reason, choose to sell a green bond on the secondary market, and chances are the latter will be easier with green bonds. In such case, the asymmetric liquidity for green bonds are to the advantage of the investor. From the issuer's point of view, the higher prevalence of buy to hold investors can be seen as a sign of loyalty for investors. The pricing of green bonds compared to regular bonds is a hotly debated topic in the market. In essence, green bonds were created for mainstream investors on the basis of equal pricing. To the extent that supply and demand and dynamics may differ, there could, however, be a case of pricing differentials. There is a lack of academic studies on the topic, and we therefore return to the Green Bond Pricing in Primary Market report, which was prepared by the CBI, the Climate Bonds Initiative, and IFC for the period October to December 2017. That report states, the new issue premium is extra yield that a buyer gets and the seller pays for a new bond, where compared to where seasoned bond from the same issuer are trading in the secondary market. A new issue premium is a standard feature in the bond market, and an issuer bears this cost to attract new investment. Occasionally, a bond may be issued at a higher price and a lower yield than the existing debt, and the bond will sit inside its own yield curve. This is known as a new issue concession, or, when present in green bonds, a greenium. Intuition suggests that a green bond should not influence the price. Green bonds rank pari passu, i.e. equal footing, with bonds of the same rank and issuer. There is no credit enhancement to explain pricing differential, and issuers of green bonds incur additional costs such as certification and third-party review. Market dynamics such as supply, uncertainty surrounding interest rates, and geopolitical issues can influence final pricing for vanilla and green bonds alike. For the analysis in the report, the sample includes just 6 out of the 23 green bonds covered in the paper. A lack of comparable bonds limits the sample size. The results of the exercise are mixed, which is consistent with what the report concluded in earlier papers. 3 bonds priced inside their curves, exhibiting a greenium, and 3 outside. Through 2016 and 2017, we have built new issue curves for 42 green bonds. The highest number of bonds still deliver a traditional new issue premium, but combining bonds priced inside the curve, that's 13 green bonds, thus exhibiting a greenium, with those priced on the curve, 10 green bonds, 55% of bonds did not exhibit a new issue premium. This split tells us that investors cannot automatically expect to receive a new issue premium. Because the group of bonds is small and mixed, we cannot make any further inferences about sector or currency. It's important to note that while the potential to achieve preferential funding conditions for green bond issuers, more so in some markets than others, there is of course no guarantee. Each bond transaction is unique and subject to market conditions at the time of issuance. When it comes to the performance of green compared to regular bonds on the secondary market, the report by the CBI and the IFC studied the relative performance of the bonds in their sample after 7 and 28 days. The conclusion was that a third of the green bonds in the sample had larger price improvements than the regular or so-called vanilla equivalents. Another difference concerning issuance of green bonds compared to regular bonds is the allocation to investors. More precisely, what proportion of the allocation that went to investors who label themselves as socially responsible or green investors. In a sample studied by the CBI and the IFC, 44% of the allocation went to labeled green investors. Underwriters have for some time tried to evaluate to what extent investors are green and distinguish between light and dark green investors, as seen in the extract from a deal review on the right-hand side. The final market aspect in this segment is marketing. Given that green bonds often finance part of the issuer's investments and activities that illustrate how the issuer aims and acts to be part of the solution in climate and environmental aspects, green issuers may be more keen to spread information about these transactions. This can become part of the overall marketing. Investors are also more likely to want to be named and to give quotes in connection to investments in green bonds compared to regular bonds for the very same reason.
So let's wrap this up. After having completed the second module, you should now be familiar with how to apply the green bond principles to set up a robust green bond framework based on the 5 core pillars: definition, selection, monitoring, reporting, and external review. You should also have gained a better understanding of key market aspects and transaction considerations, including questions around market access, liquidity, pricing, allocation, and marketing. In the upcoming third module, you will learn how external reviews and impact reporting safeguard integrity in the green bond market. If you want to get more information on the key concepts and initiatives covered in this module, you find here a list of references. Please reach out to us if you have any further questions. See you again for the next module.